Welcome to the fourth quarter economic review and outlook. My name is Karl Eggerss, and I'm here with Justin Pawl, Chief Investment Officer with Covenant. And we're going to go through several slides today to not only show you what the economy has gone through in the third quarter coming into the fourth quarter, but also what does Covenant see going forward as far as we can see, not only for the economy, but really how it impacts portfolios and our decision-making at Covenant. And the title of this presentation is To V or Not to V. Justin, welcome.
Thank you, Karl.
Thank you. Let's jump right in. You get to the agenda, and then we will go from there.
Yeah, so since our last update, the economy has continued to recover, and we've had a highly anticipated election, but that election's yet to be resolved. Now, we've also got 2 COVID-19 vaccines, but the pandemic is getting worse. Essentially, we've experienced an entire year of events in 3 months for what feels like the 7th time this year. But what can I say other than it sounds like 2020? So with that as a backdrop, let's take a look at the agenda. First, we're going to touch on the election. I want to also discuss where we are with the pandemic because it is having a dramatic impact on the economy. And we'll look into different areas of the economy to see where we're doing well and where needs improvement, essentially. And finally, touch on markets and portfolios. Just like in 2016 and so many election years before it, 2020 was another example of why it's better to vote with your ballot and not with your portfolio. And what I mean by that is no one knows in advance what the ultimate outcome of an election is going to be, nor how markets will react. I mean, the polls indicated that Democrats were going to enjoy a sweeping victory. And, you have Biden winning, big Democratic gains in the House and the Senate. And that would ultimately result in a progressive Democratic agenda, large tax increases, as well as with huge spending increases. But what actually happened was more of a blue ripple, and the polls were wrong. We had enormous voter turnout, and that led to some very close elections. Republicans lost seats in the Senate. Democrats lost seats in the House of Representatives. And as of today, the majority enjoyed by Senate Republicans and House Democrats is only by the thinnest of margins. So once again, the polls were wrong, but the markets reacted positively. So right now, with the way things stand, is that taxes are unlikely to change. You're going to only have a moderate Democratic agenda and smaller fiscal stimulus package than if there had been this blue wave. But all of this hinges on Georgia and because of the Senate race there. So let's take a closer look at that. The Georgia runoff election in the Senate is likely to be the most expensive runoff in election history, as literally the balance of power of the government rests in the election of these 2 Senate seats. If the Democrats unseat the incumbent in each race, they'll essentially be able to control the Senate because they'll hold 48 seats. They'll also have the benefit of the 2 independent party seats that generally vote Democratic. And that would lead to a 50-50 split with the deciding vote made by who is currently the Vice President-elect, Kamala Harris. And so that would shift the power of the Senate to the Democrats. And so regardless of your political leaning, as an investor, you got to pay attention to this election because this election is going to determine the type and magnitude of fiscal policy for at least the next 2 years until the midterm elections in 2022. Now, if the Democrats win both seats, we can expect a much larger fiscal stimulus plan topping some $2 trillion. We can also expect some version of the Green New Deal, which is going to provide funding to sectors focused on clean and renewable energy sources. And finally, what's important to a lot of our viewers is that we can expect Biden's plans for sweeping tax policy changes to come to fruition as well. Now, on the other hand, if the Senate remains in the hands of the Republicans, the fiscal stimulus plan is likely to be much smaller than under the Democratic-controlled Senate, and tax policy will remain as it is today. Now, the odds currently favor the Republicans winning those seats, but if the polls change to suggest the Democrats are pulling ahead, we'd expect the markets to get more volatile, as that outcome is not currently priced into the markets. So hopefully you've made clear by now that we don't suggest you change your portfolio in light of this uncertainty. Rather, it's just a warning that things could get bumpy as the calendar year flips over here into 2021. That's the election picture. Let's turn our attention to the other extremely relevant variable, the pandemic. With regards to the pandemic, the early data on the most advanced vaccines is unequivocally great news. Pfizer and Moderna both came out with information that their vaccines had a efficacy rate of 95%. And that's about twice the efficacy of the flu shot. And there's more vaccines in the pipeline. Researchers are currently testing more than 54 vaccines in clinical trials on humans, and there's at least 87 preclinical vaccines under active investigation in animals. And as you can see on the chart here, we're showing are the different phases that these vaccines are in. And I caution you that the number 6 on there in terms of those vaccines that have been approved for limited use are actually only approved in China, Russia, and the United Arab Emirates. The Pfizer and Moderna vaccines have yet to be approved. We expect that to happen before the end of November and then begin distribution around the United States. And our expectation really is that barring any setbacks, you're going to have several vaccines on the market, by the end of the first quarter of 2021. And herd immunity, meaning you can have enough people that are immune to the COVID-19 virus, could be achieved by the end of 2021 if enough people take the vaccine.
And Justin, there's really a struggle that investors are having. Do we focus on the next few months before a vaccine versus what life will be like after a vaccine? And that's really the tug of war going on in terms of how much damage do we have in the economy before the vaccines actually become, really normal and we have them distributed properly and we get back to life as normal, and really what type of economic damage that we're looking at. That seems to be the stock market struggle as we move through the next few slides.
Yeah, that's evident every day in the market. It seems like every other day you get a pivot from the work from home trade to the reopening trade. And the work from home trade, meaning the technology stocks are outperforming the more industrial stocks. The reopening trade is when you see the industrials and the financials really outperform. And you do see that tug of war every day. And one of the reasons you see that is that before the vaccine does become widely available, the U.S. is facing what looks to be a pretty grim winter, both in terms of the human lives that are at risk, as well as the economics of the virus spreading and forced closures around the country. And in this chart, in the blue line, we're showing the new confirmed cases. And what you can see here is that trend is rising significantly. And the dark line just underneath that is hospitalizations. And just as in previous rises of new cases, we expect that this hospitalization rate is going to increase over the previous 2 levels as we head into the winter here. And even though we've done a far better job of treating patients and doctors have learned a lot through this process, it looks likely that the death rate is going to increase pretty meaningfully from here. And so, I just warn you to brace yourself, because at this pace, the U.S. is set to reach about 200,000 cases per day before Thanksgiving. And what we're seeing in the economy is that the virus's spread is already forcing some states to begin enforcing changes in people's behavior through restrictions on business operations. And those restrictions are leading to faltering activity in some of the discretionary consumer services sectors. So it's pretty obvious that additional fiscal support is necessary, to save these businesses in the hardest hit sectors. But for now, unfortunately, the timing and the size of any of that help are unknowable. And unfortunately, time is not on the side of some of these businesses, and more businesses will fail through the winter. And that's going to have an immediate impact on the labor markets and longer term impacts on the economy.
So speaking of the economy, Justin, let's shift over, because we had a dramatic decrease, obviously, in the first part of the year. And then we had one of the most extraordinary recoveries just recently in terms of economic growth.
Just to level set, let's take a look at where we are with respect to the main barometer for the economy, and that's gross domestic product. So in the right bar on this chart, you can see that growth roared back in the third quarter, and it actually grew at an annualized pace of about 33%. So after a quarter in which just about every category of our economy declined, you saw a recovery in the third quarter. But even with that fantastic growth, the economy is not yet back to the pre-pandemic output level. Moreover, this recovery is very, very uneven, both with regards to geography as well as within different economic sectors. So in terms of the geography differences, what you're seeing is that varying levels of infection rates and the restrictions that local governments are putting in place to control the infections are certainly having an impact on the growth in those specific regions. And in terms of economic sector-wise, Any sector that requires humans to be present to transact, such as in restaurants, travel, entertainment, leisure sectors, those are suffering significantly. So let's take a little bit of a deeper dive and see where the strongest and weakest areas of the economy lie currently. This chart depicts the ISM manufacturing and services indices. Within these indices, the reading above 50 indicates growth, while a reading below 50 signifies contraction. And these are leading indicators that historically have been extremely useful in predicting growth in the economy. So let's first take a look at the ISM manufacturing, which is the blue line. This is a survey of purchasing managers at more than 300 manufacturing firms across the country, while the non-manufacturing survey, which is depicted in red, is a survey of more than 400 services firms representing more than 60 sectors. So in a nutshell, these are broad-based surveys. They capture a lot of economic decision-making. And what these indicated, or what these really indicate and show, is a template for what a V-shaped recovery should look like. There was a steep decline during the lockdown. They recovered not only were they the levels prior to the pandemic, but then exceeded those levels currently. These PMIs have been above 50 for more than 5 months, and they're actually above 55 right now, which is considered extremely strong. So these indices are showing that we should expect some additional growth in the coming quarters. Next, I want to take a look at housing, because housing, like a lot of the other sectors, did decline pretty significantly during the lockdown. But like the ISM manufacturing surveys, it's completed a full V-shaped recovery. And in this chart, the blue line is showing the monthly data for new single-family home sales, while the green line is a 6-month moving average to kind of smooth out the volatility in the data series. And as you can see pretty clearly, there's a clear V-shaped recovery here. And, we've all heard of these stories about people that are leaving cities and relocating to the suburbs, and that's no doubt feeding into the housing sector's strength. But I'd also point out that mortgage rates took another significant leg down in 2020, and that has made homes far more affordable and contributed to the increased demand. And I'd also note here that housing is not a huge part of the economy, but this sector really punches above its weight when it comes to gross domestic product. And the reason is that when someone buys a new home, they're typically buying new furniture, new refrigerators, new stoves, painting the house. And so it creates strong demand in adjacent economic sectors. So a strong housing sector is really key to the U.S. economic growth picture.
Which is why the Fed continues to come out and say they're going to keep interest rates low for an extended period of time, because they know how critical that is as well.
Absolutely. That feeds into that decision-making process. Now I want to turn our attention to retail sales, because this is another sector that has completed a full V-shaped recovery. During the lockdown and in the months after that, we had massive government stimulus that translated to increased household spending, particularly on goods. And the stimulus hasn't had the same impact on the service sector, as we'll see in a minute, but retail sales rose above pre-pandemic levels in what looks like a blink of an eye. In fact, if you didn't know the backstory, you would think that the April decline of nearly 8% was some sort of data error. I mean, it looks so odd in this series. But what happened next, it was perhaps even more remarkable than the decline, because as the government injected some $2.5 trillion, that's trillion with a T, of stimulus through the CARES Act, which put money directly into household accounts, and the Paycheck Protection Program, which allowed businesses to save jobs and pay employees. You had an enormous amount of liquidity being injected into the economy. And as a result, households were flush with cash. Now, they saved a lot of that cash, and that bodes well for future consumer demand, but they also spent a lot of the cash, which creates this record V-shaped recovery that you see on the chart here. However, what's interesting to note is how that money was spent, because it does provide insights into the recovery. So I want to dig a little bit deeper here. When we zoom in on what consumers are purchasing, it becomes very clear that they're purchasing goods, i.e. tangible stuff. That's what's been in high demand. On this chart, I'm showing the durable goods as well as non-durable goods. Durable goods are the blue line. Those are items that do not quickly wear out, and they're not consumed in one use, and includes big ticket items like automobiles and home appliances. Non-durable goods, again, the green line, are items that typically have a useful life of less than 3 years, or they're consumed immediately. You can think of things like cosmetics, cleaning products, and food all fall into that category. And as you can see in the chart here, consumption of both durable and non-durable goods are well above normal pre-pandemic levels. Now, I use the word normal because I do want to highlight the spike in non-durable goods that occurred just as the lockdown was being put in place. This is when people were going out and buying as much toilet paper and paper towels and Clorox bleach as they could, clearing the shelves in a lot of grocery stores. And so that spike was short-lived as the lockdown took place. But as you can see, those non-durables have troughed, and they're tracking now slightly above the range that they've exhibited since the great financial crisis.
Justin, I would say as we enter and go into Thanksgiving, one thing to be extremely thankful for is that this pandemic happened in 2020 and not 1990. In terms of technology, people were able to order things online. They were able to have groceries delivered to their homes. So the consumption, a lot of it did continue. It changed. Certainly people weren't going and doing the leisure things like cruises and flying, but they were still buying and they were improving their homes and they were getting literally appliances delivered via an online app. And so the technology we have in place now was really built for this type of pandemic. And I think that's a big reason why you saw retail sales, like you said, not only come back so quickly, but is at a new all-time high.
And we do have strong retail sales. However, the economy is not yet back to its full output. And as we mentioned before, consumption is 70% of the economy. So with record-setting retail sales, why haven't we fully recovered from a gross domestic product standpoint? And that becomes evident on this next slide when I layer in the purchase of services. So on the chart now, the gray line is services purchases. And that represents approximately 45% of total gross domestic product. At least it did prior to the pandemic. And certainly that has yet to recover. This is a picture of a not V recovery in the form of the gray line. As you can probably imagine and even recognize that services are negatively impacted by social distancing and government restrictions on mobility. Hence, because the economy is not fully open, the services sector is weighing on economic growth. And in the orange line, what you see here is a combination of the durable goods expenditures, non-durable goods, and services. And even the orange line has not yet recovered to the pre-pandemic levels. In fact, it's still negative. And I'd make a couple of observations here about future growth. And that is the pace of durable goods in terms of their expansion, that's not sustainable. Households only need so many cars, they only need so many refrigerators, and they tend to hold on to these things once they purchase them for at least several years before they replace them. So these are low frequency purchases, which are being front loaded right now because households are flush with cash. And the other thing I would point out is that in the absence of a full recovery in the services economy, because it makes up such a large portion of overall GDP, it's going to be really difficult to get back to a full GDP level that is representative of what we were enjoying prior to the pandemic. And the paradox is that right now, the only way to slow the spread of the COVID virus is social distancing. But social distancing works against growth in the services sector. And this is just one example of how rising infections in this wave of the pandemic are hurting services. In this case, we're looking at restaurants. So in the chart on the left, you can see a generalized trend of restaurant bookings just plummeting. This happens to be in Europe. And we know in Europe that COVID cases have been spiking and started increasing in advance of what we're seeing currently here in the United States. So not only are governments in those countries placing capacity restrictions on restaurants, but the higher risk of infection is also causing people to stay at home and avoid potential exposure. Now, the chart on the right shows similar data for the U.S. You have the gray, the blue, and the green lines being the U.S. Sunbelt states, the Northeast states, and then just other states. And the chart's a little busy, I admit, but the trends are really evident here. And reservations are declining here as well, just not at the rate that we're seeing in Europe. However, we believe that the situation is going to get worse here in the U.S. before it gets better, and Europe is just providing a template for that. Just as we saw at the onset of the pandemic, when Europe preceded the U.S. with caseloads by about 2 weeks, we expect to see something similar with restaurant bookings, which are already in a downtrend here. And unfortunately, the promise of a vaccine isn't going to change these trends, only the actual distribution of it. Hence, we have some real concerns about what's going to happen over the next few months with the colder weather and the ultimate impact that the virus inflicts on the economy and the labor market before a vaccine is widely available. And obviously, this is just one chart, but we could show you many charts of slowing activity, whether you're talking about consumer credit usage or mobility. There's some troubling trends that are certainly taking place right now. So now let's turn our attention to the labor market. Since the pandemic, we've regained more than half of the 22 million jobs that were lost between February and April. And the unemployment rate has fallen at a lot faster pace than anybody predicted, really. It's now at 6.9%. And that's the peak unemployment rate was 14.7% in April. So it's been an impressive rebound. But we're still 10.1 million jobs short of where the economy was prior to the onset of the pandemic. And we're seeing decelerating growth in new jobs added. In October, for example, there was only 638,000 new jobs, and that was the smallest gain in the last 6 months. We expect this decelerating trend to continue as rehiring in the industries that are most impacted by the pandemic are going to continue to be difficult as COVID cases rise, along with seeing additional state and local government layoffs. So ultimately, this chart is more of a V interrupted and will likely ultimately resemble more of a Nike swoosh than a V-shaped job recovery, simply because it's going to take a long time to replace this 10.1 million jobs.
Or Justin, as I've been saying on my podcast, the the inverse of a square root or the negative square root. So
I think what you've been saying is a backward square root, and I will not argue it does look like a backward square root.
Thank you. But yeah, when we have heard also, you talk about V's and L's and backward square root, but also the K economy, which is to say there are winners and losers, not just on the consumer side of people that are being left behind or not, and people that are benefiting from the stock market on the other side of the K, but also different parts of the economy, right? Like we talked about cruise lines, airlines really suffering, restaurants, but technology companies have really benefited from this. So we're going to see a lumpy economy. And that's why it's important as we move forward in the discussion just to talk about, again, this diversified portfolio of investments.
It's no doubt a lumpy recovery. It's an uneven recovery. And you can really see this when we look at this next slide on the labor market. And it really highlights how uneven the job recovery has been. The unusual circumstances of lockdowns and self-quarantining disproportionately hit lower paying jobs in the services sector. In this chart, which is provided by Opportunity Insights, they're a nonpartisan, nonprofit organization based at Harvard University. It really zeroes in on the disparity in job recovery, and it is a very stark difference. For example, people making more than $60,000, it's as if this recession never occurred. They're back from a job recovery standpoint. They're back at where they were prior to the pandemic. But for those in the low wage bracket that are earning less than $27,000 a year, which is the bottom blue line there, only about 50% of the jobs have been recovered. And that really is the theme of this unique economic crisis. Rather than center on the financial industry or the manufacturing sector, which are typically hit hard in recessions, this recession was born out of people staying at home. And as a result, those earning the least amount of income are suffering the greatest job losses, as these jobs are often the ones that are in industries that require human interaction, whether that's hospitality industry or the leisure industry.
Well, and this is why we're such a big advocate for another fiscal stimulus package, because more than likely it's going to involve another direct stimulus payment to people so that they can pay their rent. And it's going to go to people really on the lower end of the wage scale, like your chart's suggesting.
Yeah, and while I'm advocating for another fiscal package, I'm not unaware about how much debt the United States is taking on here. And I would, if given a voice in Congress, I would be certainly specifically asking them to help those that need it the most. The last fiscal stimulus package was pretty much a shotgun approach where they just sprayed money around the economy, and it fell in some of the right places and it fell in places, candidly, in people's pockets that didn't necessarily need it. Hopefully, given the amount of time they've had to plan for the next fiscal package, they'll be able to take more of a rifle shot approach and help those who are truly in need. I mean, ultimately, we are going to recover from this event, but the economy on the other side is going to look different than the one prior to the pandemic. The pandemic has accelerated these ongoing trends, whether that's the increasing use of technology, automation, teleworking. Even Chairman Powell, the chairman of the Federal Reserve, said that the economy is going to be different going forward. And while these changes are going to be beneficial for some, they are going to hurt certain groups in the short term. So that's the economic backdrop, along with the election and the pandemic. And let's talk about what that means for investments. To V or not to V is the title of this presentation, and equity markets are decidedly in a V-shaped recovery. You've seen equity markets achieve new highs, or in fact, right now they're very close to setting new high records. Interest rates are low, and there's not a lot of room to move lower. The Federal Reserve has said that they don't intend to raise rates anytime in the next couple of years. Of course, they could change their mind, but the market's certainly pricing in that sort of eventuality. The other thing to keep in mind is that valuations of equities and traditional fixed income investments are high. And what that suggests is that we're likely to have lower performance, lower investment returns ahead. So from an investment standpoint, how should you be thinking about portfolios? Well, our view is that we need to look for relative value. Where are there opportunities in the stock market where either the securities haven't appreciated as much as other securities, they haven't participated fully in the recovery? An easy way to think about this is to look for things that have been beaten up. And small caps, international value stocks, those all fit the bill. But the problem with fixed income, it really is creating a conundrum, because not only are you not getting much income from your fixed income investments, but the potential for capital losses if rates move higher is pretty significant. Finally, there's less protection from equity market crises. And the reason for that is typically when equity markets sell off, bond prices increase, meaning yields decline. But from a low starting point for yields, they don't have that much further to go down. So the traditional protective measures you get from the defensive fixed income portion of your portfolio isn't as significant as it used to be. And so we think that means you need to think about portfolios differently. You need to divide up your portfolio from a fixed income standpoint into what is going to drive yield and what is going to drive protection. And those two are no longer synonymous. You actually have to break those apart and think about them a little bit differently, which is something we've been having a lot of conversations about internally, and we'd be happy to share with our clients if they're interested in learning more.
And Justin, you're actually putting the finishing touch on a white paper or special report, really discussing this and talking about the new role of fixed income, or how the role of fixed income in a portfolio is likely to change and is changing as we speak. And it's going to require a little more sophistication in terms of how people put their portfolios together. And as you said, we've been spending a lot of time at Covenant on our investment committee discussing this and coming up with some really good solutions. So that report should be out pretty soon.
Yeah, and thank you for teasing that. I would have loved to go into that in more detail here, but this is not the format for that particular type of discussion, which is why I put together this thought piece on the changing role of fixed income in client portfolios. So in conclusion, we're keeping a close eye on the Georgia election because it does center on who is going to control the Senate. The vaccines that are coming online are very promising, but unfortunately, the impacts from those are going to be several months away. And we have concerns about what the economy is going to look like in between now and when these vaccines are actually distributed, and ultimately when we achieve herd immunity here in the United States. We are seeing slowing growth in the economy, and a lot of that is due to the rising COVID cases and controls that are being put in place to try and control that spread. The economic recovery is highly uneven. We provided several examples of that. And the next few months are going to really inform the next few years, because depending on the severity of damage that is inflicted on the economy in the next few months, that's going to impact the economy for years in the future. And finally, I just want to highlight that we really need to think about how to invest differently than we have over the last 10 plus years.
Thank you, Justin. And, this is a great reminder that as we move forward, not taking extreme measures based on quick news events is going to be the key. A diversified portfolio, a data-driven portfolio in terms of what's going on in the economy, which you outlaid, and what's going on in elections, but mainly what's going on in your life, what's going on in your personal financial life. And so this is meant to complement what's going on in your personal life to really develop a portfolio. And so at Covenant, we take that into consideration primarily, what's going on in your life, but also this is why we put the time and effort into this, to look at this from a big macro picture and to build portfolios that are really built for today's environment and going forward, like we talked about, especially in the fixed income world, just to have one example there. Justin, thank you very much. We appreciate you taking the time to view this. Take care, everybody.